So we're going to talk about straddle strategy, and these are the things that we're going to cover today. We're going to talk about theoretical value and how we could compare the price, the market price, versus a estimated value of the option straddle, which is very important when you're trading. We're going to do some examples of buying option straddles, selling option straddles. So the two main factors that we're going to look at is undervalued, potentially undervalued, overvalued, and catalysts of what will move the option straddle. And then we're going to do actual screens. So what we'll do is we're going to use, this screener as our basis for the presentation.
Nice.
And the other thing,
Can you show people real quick just how to find that screener, just so they know what if they're using if they're on MarketChameleon.com, just at the same time as you walking through step by step, they know where to find it.
Yep, and just above the main menu, and it's right down here, the non-directional volatility at the money straddle.
There you go. So under screeners at the money straddles, perfect.
Right. And I know you said that there's some beginners, some intermediates. So just really quickly, this is what an option straddle looks like. So I have it,
Yeah, we got about half intermediates. So they probably know what it is, but we got a good chunk of beginners. So yeah, if you walk through real quick what it is, that'd be helpful, I think.
Okay. And basically the option straddle, you're buying a call and you're buying a put right at the money. And it's non-directional. So you're looking at a non-directional play. It's really the magnitude of the move. So it's either, this is what an option straddle looks like at expiration. So you see in the red, it has to cover, right? It has to cover the cost of that straddle. So if this straddle costs $1.09, the stock has to move by that much to cover the cost before you start making money. And if you sell it, it's the other way around. So on the sell side, it would look like this, right? So as long as the stock price stays in this range, you're making money. Once it moves outside in either direction, up or down, you start losing money if you sell the straddle.
Cool. So does that make sense to you guys? It's pretty basic.
Yeah, if everybody's fine with that, I just wanted to show a visual what it looks like, before we move on. Okay. So the next thing is I wanted to talk about theoretical values. When we're trading an option straddle or anything, any kind of financial instrument, you really want to know, well, am I getting a good deal or a bad deal? Am I overpaying? And how far is the price diverging from my expected expected value? And when we talk about theoretical values for, and there are different models and different ways to get a theoretical value. The one I'm going to concentrate on today is the probability distribution of historical returns. Mm-hmm. And the easiest way I could kind of walk into it is when you think about an expected value, and here you guys could even, look it up, what an expected value is, how to calculate it. So the expected values, it's an anticipated value for a given investment at some point in the future. And you use statistics and probability analysis, to calculate the expected value. And you do it by multiplying each of the possible outcomes by the likelihood of each outcome. So here's like what the formula looks like. What do you think the probability of something happening and what the outcome is? You multiply it and sum them up. So for me here, I just did like an easy example, and I'm going to show it to you on an actual option straddle. But before we do that, let's just say you have apples, right? And you want to try to, and you're buying and selling apples. That's your business. You're buying and selling apples. Mm-hmm. And historically, let's just say this is the expected value, that 50% of the time you're going to sell the apples for $1. The other 50% of the time, before you could sell the apples, they'll either spoil or go rotten, or you're not going to be able to sell them and they're worthless zero, right? So when you do 50% times $1 plus 50% times zero, that's your expected value in the long term per apple is 50 cents, right here. So, So if your expected value is 50 cents per apple, and if you go to the farm and you could buy them for 40 cents, right? Then you're expecting like a 10-cent profit or a 25% return. Mm-hmm. So that's like a simple way of explaining, an expected value. Does that make sense?
Yeah.
Obviously, if you have different probabilities and different outcomes, it'll just keep going, right? 30% times a dollar, 30% times two, and so on.
Okay.
Right. When the other thing is, before I jump into it and look at the theoretical values, a few things I wanted to mention. It's a model, so you're estimating a value, right? And you're using certain assumptions, and you're using historical data to drive that value. And you kind of sometimes you need to determine if your analysis or historical data is relevant. So I'll show you examples of it, but like, for example, let's just say our option straddle we think is worth X amount, because the stock on average is going to move 3% in a 10-day period, right?
Uh-huh.
Well, based on the historical data. Well, let's say a stock gets taken over for $100, right? And the strike is 100, and it's $100 cash. Well, now something's changed, right? That's something different, and that stock is not going to move anymore, right? It's getting taken over $100. It's going to cease to exist. So you can't use historical data to price what you think the straddle will be worth in the next 10 days, because something's different, and that analysis and that historical data is no longer relevant. Does that make sense?
Yeah,
Same
absolutely.
thing, like spin-off, merger. So you always have to kind of take a look and see, well, what's going on, what's different? Can I still use the analysis, or do I have to look at something else, or evaluate it differently?
Yep.
Also, besides the theoretical value, what will be important is, you want to look for catalyst moves. What can possibly, upcoming, what can possibly move that I'm not taking into consideration? And there's going to be known events and unknown events. So that's one thing I just wanted to mention real quick before we jump in as well, because that's important. So known events could be something like earnings, company conference calls, or different economic releases. And these are things that we could find it. If we could find a date, we could anticipate it, and during earnings, we know the stock will move differently than during non-earnings.
Yep.
A company conference, a CEO might say something that could move the stock. An economic release, like the Fed announcement, that could make the stock move. So those are known events that we would have to take into consideration when they're coming up. But options, when in general, options kind of after 2008, this changed actually, where the options tend to be a little bit overpriced based on historicals. And the reason for that is that there are also unknown or unpredictable shocks. So we know they're going to happen. We just don't know when, and we don't know by how much. And there's also unknowns. But for example, an unknown shock, and the most recent ones we see is when we're trying to price something, there's no way for us to know that this may or may not happen, and we don't even know how to price it. So like, here's an example with the most recent ones, like when we have an election coming up, and some people think, well, we should change the healthcare system with more government controls, maybe take over the insurance industry. So that created a shock in the sector, right? That nobody could predict when somebody is going to say it, and there's no data that can predict those types of movements, right? Because it hasn't happened yet. So those types of things are going to happen. Also, a shock could happen basically and that's a sector specific. A shock could happen to just specifically to the stock. And like, for the most recent example I could find is, Facebook and Google, the Department of Justice and the Federal Trade Commission said that they're going to review the policies and, maybe break them up or do something. Nobody could predict that. That's going to make the stock move. And that's why these options are priced a little bit higher, because we don't know. We know those things happen. We just don't know when or the magnitude and how to analyze it going forward.
Yeah.
So
I'm actually going to punch in a URL there, guys, in the chat with the last video Dimitri and I did about earnings season, and that goes in pretty deep there, where Dimitri went into these sort of situations. We went in pretty deep there. If you guys have questions about that, it's in the chat. You go ahead and click on that, or or copy paste it, whatever you need to do to go watch that video on YouTube later.
Yep. Thanks. And then the last one, it could be just a entire shock to the market, something that wasn't anticipated and we don't know how to price it. So like, for example, when tariffs were introduced or there's a trade war, well, history, we didn't know that was going to happen. It wasn't like announced ahead of time. And we don't know how to price that because there's no history how this plays out.
Yep.
Right. So those are things that are going to make certain options priced a little bit higher than than most models will predict.
Yep.
So I think those are all the points that I wanted to go over before we jump into it. So I'm going to go right now to the at the money option straddle, and we're going to talk about a little bit about here are the straddles. I started from the buy side, and then we'll do a sell side. And these are the theoretical values. So we always look at to buy, right? If we're buying under what we think it's worth, the theoretical of what we think it's worth. So this is what we think it's worth. This is the market price. This is the theoretical edge. The other thing I did forget to mention is when you look at a straddle, right? When you look at this straddle, a straddle is basically, it's the market's prediction of it's a one standard deviation move up or down. So that's like a 2 standard deviation move, right? 1 standard deviation move up, 1 standard deviation move down. So it thinks that 66% of the 66% probability that it's going to land somewhere in here, right? And then the rest, it could land outside of that. So when you're looking to buy a straddle, right? Anything, a win rate even above 33%, a historical win rate above 33%, right, would be more than what the straddle's predicting. Right. Okay, because you're thinking it's about 33. So let's just go over how we get this theoretical value, to compare it to the market price, and then we'll start screening. Okay. So this is in Bank of America. Bank of America right now, it's $27.50. We're buying the 27.5 strike, the call and the put. It's predicting 3.9% move. So we need it to move more than 3.9% in the next 10 trading days for us to make money. Otherwise,
I missed that. Where'd you click to bring up that window?
Yeah. So I clicked on the load analysis. So what these are actual analysis outputs on this option straddle. So when I hit the load analysis, it tells you how we got the theoretical value.
You guys see that there? It's in the it says load there, and so that's a link. I think they got that.
Yeah. Yep. Okay. So yeah, and let's just look at how we got this, how we got the Theo, right? And then we'll go do some screening. So right now, these are the known things that we know, and some of the people if you're already using the credit spreads, it's very similar, or some of our other screeners. But basically, what we know here is that a long at the money straddle right now costs us $1.09, right, for the June 21st expiration, strike 27.5. The strike price is 27.51, and there's 10 trading days to expiration. We also know that the stock for us to make money has to drop either below 26.41 or go above 28.59 before, that's our break even. It has to go higher or lower than that for us to start making money. Gotcha. So to cover the premium we're paying. So in other words, it has to go in 10 trading days, it has to be below 4% or above 3.9%. This is rounded, or above 4%. Right. And so we want to know, well, what is the probability of that happening? Remember, we're looking at the expected value. Is that even possible, or how frequently does it happen? So then we go historically to the data and see, well, does that ever happen, or how frequently? If we knew with 100% where it's going, then it's no problem, right? But no. So let's take a look. This is going through a 4-year history, 4 years of data, 10-day holding period. It excludes earnings because there's no earnings in the Bank of America in this in this time frame.
Right.
And it has 82 total observations. So just like we did the expected value, how many times did Bank of America finish below 4% in 10 trading days? Well, that happened 20.7% of the time. And then on average, it would have ended up with an average value of $1.78. And the data is here below. How many times did it end up in 10 trading days above the 3.9%? That happened 26.8% of the time with an average value of $1.95.
Gotcha.
And then in between there, between minus 4.9 and plus 3.9, that happened 52.4% of the time with an average value of 50 cents, which we would have been losers, right? Because we paid $1.09.
Mm-hmm.
So just like we did, multiplied the probability times outcome, probability times outcome, probability times outcome. The expected value, basically, if you did this over and over and over again for 10 trading days for 4-year history, that's what the expected value is, or $1.16. Does that make sense?
Yep.
So these are the historical data. So, between this period and this period, it only moved 2.1%. So theoretically, it would have been worth 58 cents. From this period to this period, it moved more than 4%. People were okay, and that's how you would get that theoretical value to compare. This 47.6% is saying that 46 over here, 26.8, 20.7. That's how many times it actually ended up being a winner.
Right.
So even by a penny, but that's how many times it ended up being a winner historically because it moved enough to cover that premium. Okay. So that's the theoretical value. The theoretical edge is basically taking the difference, right? You're buying below, and what you risk is $1.09. So that would be 6.1% edge. Does that make sense?
Yeah.
So far to everybody?
Yep.
And that's how we start our screening to look for potentially undervalued straddles, right? Because you want a good deal. Because if you get a straddle, if you pay so much that never in history has it covered that amount, you better be, then you have to have a very good reason to believe that it's going to move that much, right? Mm-hmm. So, and really, some people just like to buy straddle, some people, or buy options. Some people just like to sell options. It's based on personality. One of the did you ever see the movie The Big Short? Sure. Michael Lewis wrote this book, right? So those guys, they're like option buy. They like to buy cheap stuff, right? So they would go in there and look at it, and especially the I forget, the two young guys. Mm-hmm. I forget their names in the movie, but that's how that's what they were doing. They were looking for catalyst moves, like what looks really cheap, and the next thing, what do you want to do? Just besides buying something that looks pretty cheap, you want to see, is there a catalyst to make this move? Like, is there something in Bank of America that will give me a little bit more edge that will make it move? So we do put over here our known catalysts that potentially can make the stock move, and these are market economic events. On top of that, you could take a look at maybe, for example, company events, and I'm going to just screen for that. So over here, you have this stock, and before this expiration, June 21st, they're having a healthcare conference. So you never know. This looks like a pretty good straddle, and there's also potential catalyst move in that stock. Nice. Where they might say something in the healthcare, and that could get investors either excited or disappointed, and that could give you an extra push in a stock, right? So those are kind of the two things that you look for. And like in the movie, they were shown, not only did they find these credit default swaps where the banks were like way mispricing them because they thought they would never default, right? But then they started looking for what's the catalyst move. And the catalyst movement, according to the movie, was that some of these mortgages that they were betting against were resetting, right? So there was a date that they started to reset, and that there was a default, right? So the interest rate reset. There was like new payments due, and they just knew that like these, no interest loans that, according to their research, that was the event that was going to trigger, the credit default swaps to start moving up. So really quickly, that's kind of the basis for buying the straddle and screening this way. I'm going to then do another one, selling a straddle, and then we'll do like a couple more screens. But let's just talk about selling a straddle here. And I'm going to flip it the other way. Let's look for selling. The thing with selling a straddle and one of the problems, they're going to look, you're going to have like high win rates and pretty good average returns. And there are people who just sell options. Like I think I was watching a video, Marty Schwartz, who was like one of the first market wizards. He sits there and he's like, I only sell I only sell. And he knows how to do it, which is fine. Really, both strategies work. I was on the floor of the stock exchange and I knew people who just bought and even if they saw good sales, they skipped them. Other people did the other way. So it's like you kind of have to do you trade according to your personality, right? You want to get good, and it's based on your personality. Some people, they can't even handle the risk of just being short options, and they skip it. It's not in their, it's not in their DNA, and I understand that completely. But so we'll talk about selling options and kind of how to price risk, because this is what you're faced with when you buy an option, when you buy straddle, your risk ahead of time. It's what you paid for it, right? So if you're buying it, that's, if you're buying it for this price or this price, that's what your risk, $8. When you're selling it, you don't know your risk ahead of time, because theoretically, here's how, let's just get back to it, right? If to the downside, you kind of know your risk because the stock can go below zero, right? To the upside, you don't really know your risk because it could go to infinity. But realistically, in finance, we have to be, what is a more realistic risk, right? It's not going to, in the next 10 trading days, it's probably not going to go to zero, right? And it's not going to go to infinity, because that doesn't happen. So you kind of have to look like, well, what is my risk? And when you look at risk, you kind of want to try to create a ratio to normalize it, right? And what we did here was we just looked at maybe catastrophic risk. So take a look over here and say, well, what is my risk? First we'll do like a 10% move. If the stock just moved 10%, that's, this is how much I collect. This is how much I would lose. And then this is the ratio. So I stand to lose 3 times as much as my biggest gain, right? $100, right? Then you want to take a look at another catastrophic risk. Like, what if it just moved 3 standard deviations, right? Like, and remember, these are catastrophic risks, right? 3 standard deviations, so 1% chance, right? So again, you take a look at it, and what is my risk? You could divide that by what's your maximum that you can make, and then so you stand to lose almost 5 times as much as you stand to gain, right? Same. And then we take the next one is, well, what is the maximum move in percentage wise that the stock's done in the last 10 years? Let's use that as a catastrophic risk.
Okay, that's interesting.
And again,
cool. Yep.
Right. So we take kind of like the highest out of these, and then we use that as the basis of what at every point, right? Historically, how much did you risk? And that's what we use as the the worst catastrophic risk out of those 10 year out of those 3. Okay. And you could even scream by that, like 3 standard deviation move, show me something like with a ratio below 3.0, right? So you could do something like that. So how much of your risk is covered by the premium, right? Same thing with historically big move. Does that make sense?
Fantastic.
Right?
What a product you guys have built, man. That is awesome. That is awesome.
Thanks. Thank you. So the other thing I'm going to jump back to, like a buy, for example, like so we're going to just go back here to the buy. And when you look to buy, right, besides maybe a catalyst move, sometimes you could look for other things. It's not just the catalyst move, but maybe the stock currently is like dropping lower, right? Well, what do we know? That if the stock, these are cheap options and the stock keeps going lower, right? Implied volatility will go up, and the drop could accelerate, right? So you could look for certain things like that. Or, for example, when you're these are just like different strategies that you could look at, or if it's like really running. Or, for example, here I'm just looking at this screener, and I'm looking at like Bank of America. I know that this is a financial stock, right? So this looks kind of cheap here. And what is a potential catalyst move? Like maybe the FOMC meeting, right? So the FOMC meeting, and if you think that maybe the Fed will decrease rates and that's going to make the stocks run really quickly, that could be a cheap play, right? Because that's kind of like your little extra push. Another thing here, I'm just looking. I'm seeing a couple other like HSBC, so some banking stocks. So I'm just going to screen for some banking stocks here, and let's try this, right? Financials. So on June 21st, let me just see any positive. So on June 21st, in the XLF, right, I'm seeing a bunch of potential undervalued options, right? That's what this is telling me, that these are potentially undervalued straddles, that the markets are underestimating the move. Well, what we also know is like, well, there's a dispersion model, right? Well, if I bought one, and any of these could move, right? Because there's always like that firm specific risk. So one of these, like you see, some of them have their own events here. Does that make sense? Like some of
I
the
see those. Yep.
there's
You guys
they
see
have their
that on the
own
far right. You can see the different potential catalysts over there, right?
right. So what can I possibly do with it? Well, what it's called is a dispersion model, right? You want to own some of the components, because any one of these components can make a huge move, right? And these are all undervalued. And let's just take a look at what the XLF is doing. So here's the sorry. So the XLF is the ETF, right? That's the ETF that holds these components. So here, if nothing's moving, the XLF is not going to move. So you could see here on the sell side, it's a little bit priced high, right? Based on our theoretical value. So that's another, 64% of the time, historically, in the last 4 years, that would have ended up being a winner. So a dispersion model would be something like where you're buying the cheap components, right, and selling the overvalued ETF. Because
Right.
what we know in the ETFs, sometimes they'll tend to be higher priced, because that's where institutions and hedge funds will go to hedge their positions, right? So that's another potential strategy. So I'm just kind of throwing out,
Sure. Those are just
different ideas what you could look at. When you also look at, like, for example, here, I'm going to jump back to the buy. Let me release
just while
that.
Dimitri's doing that, guys. Remember, down below, I know we got a bunch of questions in there right now. If you guys have other questions, I know some people put some questions in the chat. Just click on that questions tab and go ahead. You can either paste your question in there, type in your question there. And if you are new to the Chameleon, click that offer tab. You can try it free for 7 days. You can try this all out free for 7 days and see if it works for your trading style, your trading models. Some people don't need this info, but if you're trading options, this info is pretty awesome. Sorry to cut you off there, brother.
Yeah, no problem. And I'm going to get to the questions really quick. So I'll just show like maybe a couple more things, and then we'll get to the questions. So I'm just going to isolate here. Like I see, Netflix 17% edge, right? So another thing what you could do is say, okay, here's a 4 year, in the last 4 years, based on the 4-year data, that's my theoretical value, that's my theoretical edge, that's the win rate. You could change that. Well, what about in the last 2 years history? So you could still see, even using 2 years history, you could go to the 6 years, and that's one way to test the data, longer term and shorter term. Another thing, I'm going to go right now to the options chain. And this is what a lot of people then end up doing sometimes and saying, well, here's the, so here's what the straddle looks like in Netflix, right? But let's say you think Netflix is going to move. Let's say because I don't know the Department of Justice or something, they're going to say something and it's going to move, right? So you think it's going to move, but you don't think it's going to move like to infinity. So you think like it's going to move, but not too far away from its one standard deviation predicted move. So then what happens is, a lot of people then end up saying, I'm just highlighting one standard deviation moves away and strikes, and you end up maybe selling just to finance some of this, straddle of $18. You sell the one standard deviation away call. Let's do the one standard deviation put, right? Let's reload it. Then you get a butterfly, right? So now it costs a little bit cheaper.
Do you guys see
right?
what Dimitri did there? I know he moved fast, maybe a little bit on the screen there, but did you guys see that okay? Just to make sure you got people understood how you did that butterfly.
Okay.
That was a little quick. Can you just show them real quick? Mike didn't really catch that. Can you just do that again, just so people can see how to load it up? So you see he's deleting those right now, deleting the option strategy inputs, the leg inputs, and then go ahead and show them how you do it again.
Right. So now I'm looking at a straddle and it's very expensive and, it's got to move, it's got to move a decent amount before you can make money, right? $18. And, unless you think it's really going to move, right? Like, and you just think it's going like 500 in the next, 10 days. If you don't believe that, you think it's going to move, but by decent amount, but not like an incredibly decent. So one of the things is you could start picking strikes. Well, where do I think it's going to move? How far away? And it's a little bit subjective, but what I just did is this is probably typically what people start looking at is, and I just highlighted the one standard deviation. One standard deviation strikes away from the spot. And said, okay, well, if I move away one standard deviation, say like that's pretty far at that strike. I'm pretty happy. If it goes any further, it's not going to go much further than 380, right? So I'm going to sell that call. So that's what I did was, I sold that call. So that came up over here. Then I also don't think it's going to move down too far either. Like, it might move down, but it's not going to 0. It's not going to go to like 200, so not too much further than 340. So I'm going to sell that strike, to help me finance the cost. So then I load the strategy.
So then you just click the load strategy button and it reloads those all in, gives you the butterfly.
Right. So then you see like, where your break evens, they came in a little bit. So it doesn't have to move as much, right? And then you could check the theoretical value in here just to make sure it's still a good buy. So you're doing a $20. I think this is a $20 butterfly. So that's how much you stand to make if it breaks those, wings, 1380. And that's the historical win rate over here. And again, you could change it just to test it out by a number of years.
Cool.
Okay.
Nice.
Let me see. You know what? Let's go to the questions.
Let's hit it.
All right. Do you want to? I don't see the questions, so if you want to,
I'll read them. So the first one's from Mike. He's asking another amazing tool and tutorial. Thank you. Since straddles, calendars, and diagonals are all long volatility, when do you prefer one over the other?
That's I do. I really look at the theos and what my opinion is, like how much do I think it's going to really move, and I'll start looking at the catalyst. Like for example, I'll give you when I know when I was on the floor in New York on the American Stock Exchange, I remember Susquehanna just had a whole group of people looking for catalyst moves and trying to figure out, how much they would move. So they would go in there and like read the the 10Q filings, the SEC filings, and look for catalyst dates. Like Rambus was a big one. They had lawsuits, and then Rambus would say, well, if we win this lawsuit, our stock's going like up this much or down. So It'll depend on your analysis of what you think that potentially that stock can move. And then you start kind of playing with the numbers, and maybe, and just like here, where did I showed you like here, let's just come back to, oops. Let's just do that straddle again, and I'll show you like how you could start. So you do the straddle, right? But maybe you have a long lean, right? And you're like, well, I don't think it's I think it's more likely to go up than down. So I'm gonna just sell it here, so then it kind of looks like this, right?
Gotcha.
Or maybe you just want to sell out here because you're like, oh, it's not going up that high. So you just start playing around,
man.
playing
As
around
my
with
wife calls it, fiddling. You're fiddling around on the computer again.
Yeah, and you'll have to come up with some kind of an what you think is likely to happen.
Yep.
Right, and what are the potential catalyst moves that will make it move.
Awesome.
So that's
that gets it.
And I'll just looking at where do I make money? What are the ranges of prices that I will make money, and where's my best opportunity?
Makes sense. Next question is, can you give the best practices for using the new screener data with the instrument specific weekly data by day of the week? So let me repeat that. I don't know if I got that either.
Okay.
Can you give any best practices for using the new screener data with the instrument specific weekly data by day of week? So I think he's talking about like Monday through Friday. Is there a day to do it, specifically Mondays or specifically Wednesdays, something like that?
Yeah, I think this straddle, this at the money straddle is a little bit different. So it doesn't look from like Monday to Tuesday. I know what he's talking about. If you go to like a specific stock, like over here, let me see here.
Well, Dimitri's looking that up, guys. Remember, if you have any more questions, we still have 15 minutes or so. I think we might get through these questions. So if you have any other questions, click below my face, click on that questions tab and type your question right in there. Don't feel embarrassed if you're a newbie like me. No question is too silly. Dimitri can handle them all. So what do you got for us there?
Yeah, so this is kind of a back test of how actual option straddles perform if you did them from if you did it on Monday and got out on Friday, if you did it on Monday and got out on Thursday, to kind of see like where did they decay the most, where did they move the most.
Where did you how do you get to that one? I wasn't watching, just so everybody sees how you got there.
It's if you go to like a specific stock. I just went back to Bank of America and hit the at the money straddle performance.
Okay.
And this will give you kind of the statistics also. I think there's like some more, you said advanced guys in here. They might look at the delta rehedging and see how that, because really, if you're a professional and you're just trading the volatility, and you're using like the Black-Scholes model, the binomial, you're really looking at the average daily volatility. So you're trying to scalp between the average daily realized volatility and average daily implied volatility. It's a little bit outside the scope of this webinar. I think it's like really more advanced. So I'm not going to get too much into it because I think that would it would take me more than just one webinar. But in essence, like when you're looking at it here, I'll show you. If you're a professional trader, if I buy this call, right, and really I'm trading volatility, so I don't want this delta, right? I have a delta here. It has to go up, right? So I have this delta 53. Let's say I have 10 of these, all right? So 533 delta. Well, if I'm a professional, I hedge this. So basically, you're creating a synthetic straddle, and I'll show you how it looks. So if I hedge this delta, right, I don't want that risk. I sell. I'm just going to do approximately 500 shares of stock to get this delta neutral, and it'll look like a straddle, right? So professionals, that's what they were. It doesn't matter if they're buying that call, to them, it's the same thing as doing the straddle. Because you're going to hedge that delta.
Nice. Dude, that's tight, man.
Okay.
Mike is asking maybe, he's maybe not a question, maybe a statement. Maybe one day, if it's not too difficult to program, we could get the catalyst indicator to appear on the instrument's main page as well as in the screener, since we may not always be looking at the screener page.
Oh,
Do you understand that?
okay. I think so. Like, that's Mike. Is this
Yeah, that's
because
Mike. Yeah. Get the catalyst
we do have
indicator to appear on the instrument's main page as well as in the screener, since we may not always be looking at the screener page.
Yeah, and we do put, like, for example, where we expect earnings, or if there's like a little, like here, let's see, like here, there's a company event here in the ABBV. So if you look at the options chain,
Mm-hmm.
we put a little bit of we put that indicator right here. So here's like potential catalyst moves.
Yeah, that's pretty awesome. Yeah.
Yeah.
Nice. Dude,
Yep.
is the Chameleon getting better every single day? It's incredible.
Yeah. Yeah. We got a lot of fans.
A lot of fans.
And by the way, thanks for everybody, because I do get a lot of like very good emails. So
Absolutely.
I really appreciate it. Thank you.
Absolutely. A different Mike, not the Mike we are familiar with, asks, so can you look at one industry just by picking the ETF?
Well, yeah, you could take a look at in the straddle. Where did I go? So, like, for example, if you just want that ETF, you could just search for, like, here, I think I did the XLF, right? So that's the ETF, that's the financial ETF, right? The S&P 500. So you could just look at that, or you could look at all the components in it. So you could go look and say, well, what are the components in the ETF doing? So you could do it that way as well.
Yep.
See, so if you wanted all the components that have events coming up, for example, right? Now, we don't know all the catalysts. These are the ones that we pick up. Of course, there could be other ones out there that we haven't seen. And obviously, there's always the unknown, right? So like we were talking about, there's always something potentially that we cannot predict, and we don't even have the data, right? So when we do this analysis, and if there's something making these stocks move, like, for example, like, I don't know, like a new tariff comes up. Well, this data doesn't have it, right?
That's right.
We don't know. So we don't know how much potential movement or it's going to impact that price.
Yep. Makes total sense. He has a follow-up question. He's asking about, is the option chain page real time? So is the data, I'm assuming the data on the option. Yeah.
So the options chain it's on a 15-minute delay. And then it does some calculations. So it does run through like some processes because it's crunching a lot of numbers here.
Yep.
You have like back test analysis and you have all this stuff. So no, it's not a live options chain, right? The idea there is like you could perform analytics there, theoretical values. You got historical stuff. You could go back in time.
Yep.
And see data. So yeah, it's not a real-time trading application. It's a analysis tool, right?
And it's pretty dang awesome
For research.
Wayne is asking.
Delay, so it is intraday. It's updating.
It's updated all day long. It just takes some time to pump through. Yeah,
exactly. But it is updating all day long.
Right. So Wayne's asking, when I try to do a diagonal spread, there are not enough entry windows on the time or vertical tabs to enter all the necessary info. Or am I missing something? Or can that option be programmed for diagonals?
So I think what he's referring to diagonals, like he will do, like, for example, buy an option in one expiration, then go out a different expiration and sell maybe a strike below, like this. Is this kind of what you're trying to do?
Wayne, is that where so different strikes and times?
Right. So that's how this would look like. And really, when you're doing a diagonal between different expirations, one expiration is going to expire, the other one is not, right? So you have July 5th will be gone, or June 21st in this case will be gone. July 5th still exists. So there's no way to know at July 5th what it is. So we stop it at June 21st, right? So once this option expires, that's where we stop it, right? That's the predicted value based on this implied volatility. So that's how we do it. There's no way to go past that first expiration.
Does that make sense, Wayne, for you? I think that did it for him, man. Look at that, dude. Blew through all the questions. Oh, wait, here comes another. This is the way it always is, man. You do all the questions, and then we're ready to end the webinar. I'm going to get some dinner, and here come the other questions, man. All right, here, Mike's saying, sometimes I'm right about a stock moving up, but I don't give myself enough time. Buying an option 2 weeks left versus going out to the next month. What tool helps you find the best expiration?
That's tough to say, because if you're expecting it to go up, by when, right? So is there like some type of news or something that you're looking for? But you kind of have to, choose that expiration. So maybe if you're playing, like, I don't know, let's say you're using the seasonality screener, right? And you think by the end of whatever, let's say by the end of June, let's just take a look what pops up. So if you're playing this, let's put a little bit more observations. So, if you think like, oh, well, I think on average, this has increased 7.2%, by the end of June, then you want to make sure it covers that, that the end of June, whatever expiration you pick, it covers that. But it really depends on, why you decide, why you think the stock's going to go up in the next 2 weeks, 3 weeks.
Okay. Yeah, I'm not exactly sure what he meant. And that's only because I don't know what I'm doing. But you guys know what you're doing.
Yeah, or you could do a spread, you could do a time spread.
Right.
But I'd need more information, kind of, just to know what your expectation is.
Right. All right, guys. Any more questions? Going once, going twice. Dimitri, we got this polished off with 8 minutes to spare, my man.
Nice. All right. Well, thank you, guys. I try to make it quicker this time to get more questions.
Dude, we love doing these things. I got another one coming up in about 2 weeks with Jay Soloff. He's our volatility specialist. That's for premium members. So, guys, hey, try it out. Click that offers tab down below. Try the Chameleon out free for 7 days. Of course, most of the people in the chat, you guys have been here with us. Most of these people are premium members anyway. But if you haven't tried it out, try it free for 7 days, and you'll learn why. The Chameleon will help you be a better trader. So thanks for joining us, guys. Love you.